Salik is Dubai's exclusive toll gate operator, an essential piece of the Emirates' roads infrastructure with a monopoly concession that runs all the way to the year 2071. For investors, Salik offers exposure to one of the most defensively structured and highest margin businesses on the Dubai financial market. So, is Salik a stock worth tracking? Let's break it down. Salik Company PJSC was incorporated in 2022 and listed on the Dubai financial market on September 29 of that year under the ticker symbol SALIK. The company operates under a 49-year concession agreement with Dubai's Roads and Transport Authority, the RTA, which grants Salik 100% exclusive rights to operate all existing and any future toll gates in Dubai until 2071. That single sentence is the entire investment thesis in a nutshell. Salik currently operates 10 toll gates across Dubai, including the two newest ones, Business Bay Gate and Al Safa South Gate, which came online in November 2024. The business model is elegantly simple. Toll usage fees make up the vast majority of revenue. The rest comes from traffic fines, Salik tag activation fees, and a growing stream of ancillary revenues from parking, insurance, EV charging, and fuel payment partnerships. Because the infrastructure already exists and operating costs are tightly controlled, Salik converts revenue into profit with extraordinary efficiency. Now let's look at the numbers. According to Salik's official FY 2025 earnings released, full year revenue reached 3,096.9 million dirhams, an increase of 35.1% year on year. EBITDA rose 35.8% to 2,143.9 million dirhams, with an EBITDA margin of 69.2%. Net profit climbed 33.4% to 1,553.4 million dirhams, a net profit margin of 50.2%, which is among the highest of any listed toll road operator globally. Total chargeable trips reached 639.1 million during the year. Two things drove this exceptional performance: the full year contribution of the two new toll gates opened in late 2024 and the implementation of variable pricing on Jan 31, 2025, which introduced higher fares during peak hour travel. For dividend-focused investors, Salik continues to be one of the most attractive names on the DFM. The board proposed total cash dividends of 890.3 million dirhams for the second half of 2025, plus a special dividend representing 100% of net profit distributed to shareholders. The dividend policy is essentially a full pass-through of earnings, which reflects Salik's low capital intensity and highly predictable cash flow profile. The first quarter of 2026 tested that resilience. According to Salik's official Q1 2026 earnings release published on Salik.ae, revenue came in at 728.9 million dirhams, down 3% year on year. Net profit stayed essentially stable at 369.3 million dirhams, down just 0.4%. EBITDA margin actually expanded 44 basis points year on year to 69.6%. Net profit margin expanded 135 basis points to 50.7%. Total trips fell 6.4% to 197.2 million, reflecting reduced traffic during the exceptional geopolitical events in March. Despite the traffic decline, free cash flow rose 1.6% to 636.5 million dirhams. Net debt fell 11.9% to 4.23 billion dirhams, taking net debt to EBITDA down to just 1.98 times, well below the 5x covenant limit. Fitch also upgraded Salik's issuer rating to A, and Moody's reaffirmed A3, both investment-grade ratings that reflect the resilience of the cash flows. Ancillary revenue surged 147% year-on-year to 8 million dirhams, supported by new partnerships with Dubai airports across Terminals 1, 2, 3, and Cargo, Emaar Malls, Parkonic, Liva Group, Waltrons for digital wallet payments starting June 2026. EV charging integration with Schneider Electric and a fuel payment pilot with Enoch are expected later in 2026. From an investor's perspective, there are 5 things to monitor closely. First, chargeable trip volumes and how quickly they recover from the Q1 traffic weakness. Second, the performance of variable pricing, where the peak hour revenue premiums continue to expand. Third, growth in ancillary revenue as Salik scales its e-wallet platform beyond tolling. Fourth, dividend sustainability with the payout ratio near 100%, growth requires profit growth. And fifth, whether Dubai's population and tourism growth continue to support long-term traffic expansion. Salik is not a growth technology stock. It is a monopoly infrastructure business with essential service characteristics, extraordinary margins, and one of the most consistent dividend profiles on the DFM. So is Salik a stock worth tracking? Yes. The company has delivered record revenue, record EBITDA, high margins, credit rating upgrades, and a full pass-through dividend policy, all backed by monopoly concession until 2071. But investors should continue to monitor traffic recovery, ancillary revenue execution, geopolitical risk, and valuation carefully. A defensive monopoly is not automatically a buy at every price. This video is for educational and information purposes only. It is not investment advice or a recommendation to buy, sell, or hold any security. Please conduct your own research or consult a licensed financial advisor before making investment decisions.